You know what terrifies most people over 60? It's not death. It's running out of money before you run out of time. I've seen brilliant engineers, successful executives, people who built entire careers, suddenly panicked at 65 because they realized their nest egg might not last. And here's the brutal truth. Most financial advisors are lying to you, not maliciously, but they're operating on assumptions that haven't been true for 20 years. They'll tell you to put everything in bonds for safety. They'll tell you the stock market is too risky at your age. They'll tell you to accept 3% returns and pray inflation doesn't eat you alive. That's not a plan. That's surrender. I'm Jensen Huang. I built NVIDIA from nothing into one of the most valuable companies on earth. I've navigated multiple market crashes, technology revolutions, and near-death business experiences. And I'm going to tell you something that might sound contradictory. If you're over 60, you need to be both more conservative and more aggressive than you think. Conservative in protecting what you have, aggressive in refusing to accept poverty-level returns that guarantee you'll go broke slowly. The game changes after 60. Your margin for error shrinks. You can't just work 5 more years to rebuild from a catastrophic loss. But that doesn't mean you should accept defeat. It means you need to think differently. You need a strategy that protects your downside, absolutely, while still capturing reasonable upside. And yes, 10 to 12% annually is achievable without gambling your retirement on cryptocurrency or penny stocks. Let me be clear about something right now. I'm not going to sell you on some magic investment product. I'm not going to tell you to put everything into NVIDIA stock, even though I obviously believe in what we're building. What I'm going to share with you is a framework, a way of thinking about capital preservation and growth that comes from 30 years of building a company in the most volatile, competitive, unforgiving industry on earth. Technology moves faster than any other sector. If I can build durable value in that chaos, you can protect and grow your wealth in retirement. Here's the first principle you need to understand. Safety is not the same as safety. Let me explain what I mean. Most people think safety means putting their money in treasury bills or certificates of deposit, zero risk, right? Wrong. That's not safety. That's the illusion of safety. Because while your principal sits there collecting 2 or 3%, inflation is running at 4 or 5 or 6%, you're losing purchasing power every single year. In 20 years, your safe investment has lost 40% of its real value. You didn't protect anything. You just chose a slower form of going broke. Real safety means preserving purchasing power. It means your money can buy the same amount of goods and services in 20 years that it can today. Anything less than that is failure. And to achieve real safety, you need returns that outpace inflation by a meaningful margin. That means you need to earn somewhere between 8 and 12% annually, depending on what inflation actually does. Not what the government says inflation is, but what you actually experience when you buy groceries, pay for health care, and cover your real living expenses. Now, how do you get 8 to 12% without taking stupid risks? This is where most financial advice falls apart. They tell you it's impossible. They say you have to choose, either accept low returns for safety or take big risks for higher returns. That's a false choice. And I know it's false because I've spent my entire career proving it wrong. At NVIDIA, we don't make reckless bets. We can't afford to. One wrong move in chip design costs us billions of dollars and years of time, but we also don't play it safe and settle for mediocrity. We find the intersection of high probability and high impact. We take calculated risks where the downside is manageable and the upside is significant. That same philosophy applies to managing your retirement capital. Let me walk you through the framework. First, you need to accept that you're going to hold multiple types of assets. Not because diversification is some magic word, but because different assets protect you from different risks. You need some assets that protect against inflation. You need some assets that generate income. You need some assets that can grow. And you need some assets that hold value when everything else is falling apart. Here's how I would structure a portfolio if I were 65 years old today with, let's say, $1 million to invest. And before you say, Jensen, I don't have $1 million, the percentages work the same, whether you have 100,000 or 10 million. The principles don't change. I would put 30% into what I call the foundation layer. This is boring, stable, income-generating stuff, high-quality, dividend-paying stocks from companies that have survived multiple recessions, not the hot growth stocks, not the companies promising to change the world, companies that make products people need regardless of economic conditions. Think utilities, consumer staples, healthcare, companies that have paid and increased dividends for 25, 30, 40 years straight. These companies are boring. And boring is beautiful when you're over 60. Why 30% here? Because this layer generates income you can actually spend without selling anything. If these stocks yield 3 to 4% in dividends, that's $12,000 to $16,000 a year on a $500,000 investment. That income helps cover your living expenses, which means you're not forced to sell stocks in a down market. You can be patient. Patience is the most valuable asset in investing. But most people can't afford patience because they're forced to sell at the worst times to pay bills. The second layer, I'd put 25% into inflation-protected assets. This is where most people get it wrong. They think this means gold or commodities or cryptocurrency. Maybe a small position in those makes sense, but the real inflation hedge is real assets that generate cash flow. Real estate investment trusts that own essential properties, apartments, warehouses, medical facilities, infrastructure assets, toll roads, pipelines, communication towers. These assets have pricing power. When inflation rises, they can raise rents or fees. Their income keeps pace with inflation, and so does their value. The beautiful thing about REITs is they're required to pay out 90% of their income as dividends. So you're getting income, inflation protection, and the liquidity of a stock all in one. You can't get that from owning a rental property directly, where you're dealing with tenants and toilets and property taxes. This is passive, real asset exposure. And it's essential for anyone over 60 because inflation is the silent killer of retirement portfolios. Now here's where it gets interesting. The third layer, I'd put 30% into what I call asymmetric compounders. These are high quality growth companies that have durable competitive advantages and are still in the early stages of a long growth runway. And yes, I'm talking about technology companies. I know. Everyone says technology is too risky for retirees. They're wrong. Technology isn't risky. Bad technology companies are risky. There's a massive difference. The greatest companies of the next 20 years are being built right now in artificial intelligence, cloud computing, semiconductor design, biotechnology, clean energy. These aren't speculative gambles. These are fundamental shifts in how the world works. And the companies leading these shifts are going to compound at 15, 20, 25% annually for the next decade or more. You don't need to own 50 of them. You need to own 5 to 10 of the absolute best. The companies with massive moats, visionary leadership, and business models that print cash. Think about this. If you had put money into Microsoft, Amazon, or yes, Nvidia 20 years ago and just held it, you would have compounded at 25 to 30% annually. That turns $100,000 into over $3 million. Even if you invested just 10 years ago, you'd have multiplied your money 5 to 10 times. Now, I'm not saying past performance predicts future results. I'm saying that exceptional companies with strong competitive positions and massive market opportunities tend to compound wealth over long periods. And you don't need all of your portfolio in these companies, just 30%. But that 30% can drive the majority of your returns. Here's the key. You have to ignore short-term volatility. Technology stocks swing wildly. They can drop 20, 30, 40% in a bad market. But if you have your foundation layer generating income and you're not forced to sell, you can ride through those drawdowns. And on the other side, when the market recovers, you participate fully in the upside. The fourth layer, I'd keep 15% in what I call the shock absorber. This is the most conservative part of the portfolio. Short-term treasury bills, money market funds, maybe some intermediate-term government bonds. This money is there for two purposes. First, it's your emergency fund. If you need cash immediately, you're not forced to sell stocks at a bad time. Second, it's your opportunity fund. When markets crash, and they will, you have dry powder to buy assets at discounted prices. This is how wealthy people actually get wealthier during crashes. They have cash available when everyone else is forced to sell. In March of 2020, when COVID hit and markets dropped 35%, people with cash could buy incredible companies at bargain prices. 6 months later, those investments had doubled. But you only get that opportunity if you have cash available and the psychological strength to buy when everyone else is panicking. The math on this portfolio structure is simple. your foundation layer yielding 3 to 4%, your inflation protected layer yielding 4 to 5%, your asymmetric compounders growing at 15 to 20% but experiencing some volatility, your shock absorber earning 2 to 3%, blend it all together, and over a full market cycle, you're looking at 10 to 12% annual returns with significantly less volatility than a pure stock portfolio. But here's what makes this strategy actually work. It's not just about the allocation, it's about the behavior. Most people destroy their returns through emotional decisions. They panic and sell at the bottom. They get greedy and buy at the top. They chase performance. They overtrade. They listen to financial media predicting the next crash or the next boom. All of that is poison. The key is to set this allocation and then do almost nothing. Rebalance once a year. If your growth stocks have run up and are now 40% of your portfolio instead of 30, sell some and buy more of your foundation or shock absorber layer. If there's a crash and your growth stocks drop to 20%, buy more with your shock absorber money. This is mechanical. This is unemotional. This is how you actually capture the returns. Let me tell you a story from NVIDIA's history that illustrates this principle. In the early 2000s, we made a massive bet on a technology called CUDA. We invested billions of dollars into building a parallel computing platform that, at the time, almost nobody wanted. Our stock got hammered. Analysts said we were wasting money. Competitors mocked us. Our own employees questioned the strategy. But we believed in the long-term vision. We knew that parallel computing would eventually become essential for artificial intelligence, scientific computing, data analytics. We knew the world was going to need what we were building, even if they didn't know it yet. So we stayed disciplined. We kept investing through the criticism and the doubt. Fast forward 20 years, CUDA became the foundation of the entire AI revolution. Every major AI model, every data center, every autonomous vehicle runs on NVIDIA technology built on that platform we refuse to abandon. That bet, which looked crazy at the time, created hundreds of billions of dollars in value. The lesson isn't that you should make crazy bets. The lesson is that when you have strong conviction based on sound reasoning, you have to tune out the noise and stay disciplined. The same applies to your portfolio. When markets are crashing and everyone is screaming that stocks are dead, you need the discipline to hold. When markets are soaring and people are saying bonds are worthless, you need the discipline to rebalance. Now let me address something important. Taxes. Nobody wants to talk about taxes, but taxes are one of the biggest drags on investment returns, especially for retirees. If you're in a high tax bracket, you're losing 30, 40% of your returns to taxes. That's unacceptable. This is where structure matters. If you have money in tax-deferred accounts, like traditional IRAs or 401k plans, that's where you put your high turnover investments and your income-generating assets. Dividends and interest get taxed as ordinary income, so shield them in tax-deferred accounts. Your growth stocks that you're holding for decades, those can go in taxable accounts because you're not realizing gains until you sell. And when you do, it's at the lower long-term capital gains rate. If you have Roth IRA money, that's your most powerful tool. Roth accounts grow tax-free forever. That's where you want your highest growth assets. Put your asymmetric compounders in there and let them compound for 20 years without ever paying a dime in taxes. $100,000 growing at 15% annually for 20 years becomes over $1.5 million completely tax-free if it's in a Roth. Also, think about tax loss harvesting. If you have positions that are down, you can sell them to realize losses, which offset gains elsewhere in your portfolio, or offset up to $3,000 of ordinary income per year. Then you immediately buy a similar but not identical investment to maintain your exposure. This is free money. You're cutting your tax bill without changing your actual investment position. Here's another critical piece that nobody talks about: sequence of returns risk. This is the danger that you'll experience poor returns early in retirement, which can devastate your portfolio even if returns are good later. Let me illustrate. Let's say you retire with $1 million and you're withdrawing $50,000 a year. If the market drops 30% in year one, you now have $650,000 after the drop and your withdrawal. Even if the market recovers and delivers great returns for the next decade, you've permanently impaired your ability to compound because you had to sell stocks at depressed prices to fund your living expenses. This is why the shock absorber layer is so critical. And it's why I recommend having at least 3 to 5 years of living expenses in cash and short-term bonds. Yes, that money is earning low returns, but it's buying you the most valuable thing in investing, the ability to wait. If markets crash in your first few years of retirement, you live off that cash buffer. You don't touch your stocks. You let them recover. And when they do, you're whole again. Think of it like this. In business, we always maintain what we call strategic reserves, cash and credit lines that we can tap in a crisis. During the financial crisis of 2008 and 2009, companies that had strong balance sheets could invest in research, acquire distressed assets, and hire top talent while their competitors were cutting to survive. When the economy recovered, those companies with reserves dominated. Your portfolio needs the same strategic reserve. It's not about maximizing returns on every dollar. It's about maximizing the probability that you'll never run out of money, regardless of what markets do. Let me address another uncomfortable truth. Healthcare costs are going to destroy most retirement plans. People underestimate this catastrophically. The average couple retiring at 65 will spend $300,000 on healthcare over the rest of their lives. And that's average. If you have significant health issues, it could be double or triple that. This is why I'm such a strong believer in health savings accounts for anyone who qualifies. HSAs are the most tax-advantaged accounts in existence. Contributions are tax deductible. Growth is tax-free. Withdrawals for medical expenses are tax-free. It's a triple tax benefit. If you're still working and you have a high deductible health plan, max out your HSA every year. And here's the secret, don't spend it. Pay your medical expenses out of pocket and let the HSA grow. Invest it aggressively because you won't need it for another 20 or 30 years. By the time you're 80 and facing serious medical bills, that HSA could be worth hundreds of thousands of dollars, all available tax-free for healthcare costs. That's a massive insurance policy against the single biggest financial risk in retirement. Now, let's talk about something most financial advisors will never tell you. The traditional 4% withdrawal rule is obsolete. For decades, advisors said you can safely withdraw 4% of your portfolio annually and never run out of money. That was based on historical data from a period when bonds yielded 6 to 8% and stocks were reasonably valued. Neither of those things is true today. With current bond yields and stock market valuations, withdrawing 4% annually has a significant probability of failure over a 30-year retirement. You might need to start at 3 to 3.5% to be truly safe. That's painful because it means $1 million portfolio only generates $30,000 to $35,000 of safe income, not the $40,000 everyone was planning on. But here's the solution. If you can generate 10 to 12% returns using the strategy I outlined, you can afford to withdraw 4% or even 5% safely because your portfolio is growing faster than you're depleting it. This is why returns matter. It's not about greed. It's about mathematics. Higher returns give you more flexibility, more security, and more ability to enjoy your retirement without constant fear. I also want to address the biggest mistake I see retirees make. They become too conservative too quickly. They retire at 65 and immediately shift everything to bonds and cash because they're terrified of market volatility. Here's the problem. If you retire at 65, you might live another 30 years. That's not a short time horizon. That's longer than many people's working careers. You still need growth. You can't afford to lock in 3% returns for 30 years. Inflation will annihilate you. Instead, you need to stay diversified and maintain exposure to growth assets. Yes, reduce your stock allocation from 90% to 60 or 65%, but don't go to 20% stocks and 80% bonds. That's a guaranteed path to running out of money. Remember, you're not investing for next year or even the next 5 years. You're investing for the next 30 years. Think long term, be patient, ignore the daily noise. This is the same mindset that built NVIDIA. We didn't optimize for quarterly earnings. We optimized for building something that would matter decades from now. Your portfolio deserves the same long-term thinking. Let me share one more principle that's been central to everything I've done. Focus on what you can control. You cannot control what the stock market does tomorrow or next month or next year. You cannot control inflation or interest rates or whether there's a recession. Worrying about those things is wasted energy. What can you control? Your savings rate, your spending, your asset allocation, your tax strategy, your behavior during market volatility, whether you rebalance systematically, whether you stay disciplined to your plan. These are the things that determine your success. At NVIDIA, we don't spend time worrying about what our competitors are doing or what analysts are saying or what the stock price is doing day to day. We focus on making the best products, serving our customers, investing in innovation, the things we can actually control. And over time, when you control what you can control and execute well, the results take care of themselves. Your retirement is no different. Control your behavior, control your costs, avoid stupid mistakes, stay disciplined. The market will do whatever it's going to do, but if you stick to sound principles, you'll be fine over the long run. Here's my final framework for anyone over 60. Write this down. First, understand that safety means beating inflation, not avoiding volatility. Second, build a portfolio with multiple layers serving different purposes: income, growth, inflation protection, and liquidity. Third, maintain enough cash to weather 5 years of living expenses without selling stocks. Fourth, stay diversified but concentrated in your best ideas. Fifth, minimize taxes through intelligent account structure. Sixth, ignore short-term noise and stick to your plan. Seventh, rebalance mechanically once a year. If you do these 7 things, you don't need to be brilliant. You don't need to pick the next Amazon. You don't need perfect timing. You just need discipline and patience. And over time, earning 10 to 12% annually becomes not just possible, but probable. The wealth you've built over your lifetime deserves to be protected and grown intelligently. Don't surrender to the lie that you have to accept mediocre returns just because you're over 60. You have the knowledge, the experience, and hopefully now the framework to do better. The question is whether you have the discipline to execute. Because in the end, that's all that separates success from failure. Not intelligence, not luck, discipline.